Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In our last episode, I explored two big questions. Why should we learn about different financial products? And what kind of realistic returns can we expect from trading? We figured that understanding financial products can unlock life-altering benefits. And we introduced the concept of Sharpe ratio as a practical benchmark for measuring returns in trading. In today's episode, I'll take the conversation a step further. We are diving into two fundamental approaches to trading, breaking down what they are, how they differ, and which one might actually work better for you. And that is discretionary versus systematic approaches to trading. But to understand these two approaches, we would have to step back a little and go into two other concepts, which are active versus passive investing. If you looked at mutual funds, you've heard of these labels. ABC is an active large cap fund or XYZ is a passive index tracker. But what do these labels really mean? And more importantly, what relevance do they have for us as traders? To understand that better, we would have to go a good 65 years back. The roots of passive investing go back to 1960s when academics started questioning whether actively managed funds could consistently outperform the market. This line of thinking was closely tied to the concept of efficient market hypothesis, EMH as it's called. The idea that markets reflect all available information, leaving almost no room for active managers to find an edge or generate alpha. A decade down the line, by 1970s, Burton Malkiel's classic book, A Random Walk Down the Wall Street, made this efficient market debate quite mainstream. He argued that stock prices move in a random pattern because all known information is already factored into the price, making it extremely difficult even for professional managers to beat the market over long periods of time. If you want to dive deeper into EMH and understand why passive investing matters, this book is a classic and a must-read of sorts. As always, I'll link it in the show notes. Moving on, not long after the book was published, John Bogle, yes, the legendary John Bogle of Vanguard fame, put the concept into practice. In 1976, he launched the world's first index mutual fund at Vanguard, designed to track S&P 500. It was then called the first index investment trust. At that time, the idea sounded so radical that critics mocked it, calling it Bogle's folly. But what started as an experiment eventually became the foundation of a multi-trillion-dollar passive investing industry we see today. Talking about Bogle and Vanguard, I just want to give you a sense of their scale. Their flagship fund, which is today called Vanguard 500 Index Fund, manages an AUM of $1.3 trillion. That is close to 114 lakh crores in rupees, and that is a bit more than the combined AUM of all mutual funds and ETFs in India, which is roughly around $1 trillion, which comes close to 88 lakh crores. In other words, this one particular passive mutual fund scheme in the US has more AUM than the combined AUM of all funds in India. Mind-boggling, isn't it? Anyways, let's get back to understanding what exactly is passive investing. For passive investing to even exist, you need something called a market index. In India, our two most recognized benchmarks are Nifty 50 and the Sensex. I won't get into the mechanics of how an index is built. If you're curious, Varsity has an excellent explainer video on it. I'll share it in the show notes. At its core, passive investing simply means buying into a broad basket of stocks that make up an index. Now, here's the key difference. These stocks are not handpicked by a fund manager. Instead, they are selected automatically based on predefined rules or criteria. If a company meets the criteria, it gets included. If it no longer qualifies, it gets dropped. For instance, if we look at Nifty 50, which is rebalanced twice a year, last March we had two stocks, Eternal and Jio Financial, which got included in the index, and BPCL and Britannia Industries got removed. That's the beauty of it. Passive products are built to mirror an index. There is no human judgment involved in choosing which stocks to add or how much weight to give it. The goal is simple: replicate and track the index as closely as possible. Now let's flip the coin and look at the other side, which is active investing. This approach has been around for as long as stock markets themselves. In active investing, an individual or a professional fund manager picks stocks and decides their weightage based on research, analysis, and judgment. It's called active because it requires constant decision making at every step. Think of it this way: active versus passive is like driving versus taking a train. Imagine you need to travel from Bangalore to Delhi. Passive investing is like taking the train. The route, the destination, the seat, everything is fixed. You don't need to decide anything. Just buy the ticket, sit back, and you'll reach your destination. Active investing, on the other hand, is like driving. You choose the route, the stops, the speed. Maybe you decide to stop at Indore for its famous poha jalebi, or maybe you skip it and choose Kota instead for its kachoris. Don't bother, I won't judge you on your choice. Every decision you take shapes your journey. Similarly, as an active investor or trader, you are in control of every choice: what to buy, when to sell, and how much to risk on a given stock. Come to think about it, in a way, that's what this show, The Long and the Short, is really about. Almost everything we discuss here falls into the active category. It's about how do we become a better active investor or trader. But I must say, as much as I live and breathe active investing and trading, I am in total awe of the idea of passive investing through an index fund. It is indeed a remarkable financial innovation of the 20th century. Back to active versus passive. Incidentally, Benjamin Graham, often called the father of value investing and the author of the book The Intelligent Investor, made this distinction between active versus passive long before the idea became mainstream. But he used slightly different words. He spoke about enterprising investors versus defensive investors. And frankly, I think that framing is more accurate than just active versus passive. Now that brings us back to the key question of today's episode. What are the different ways to be an active investor? But when you choose to be active, all your key decisions, what stock to pick, how much to allocate, when to enter, when to exit, are made actively. But the way you make those decisions can follow two different paths. Discretionary is when you as a human observe the markets, maybe look at some data, and then make judgment calls as to what to buy, when to sell, and at what size. Systematic approach, on the other hand, is when all those decisions are governed by predefined rules. You codify your strategy, stock selection, weightage, entry, exit. All of it runs on a set of rules, often backed by data and tested historically. In other words, what lives in the mind of a discretionary trader is translated into rules and code for a systematic trader. For today's episode, I'll keep systematic, rules-based, and quant approaches in the same bucket. Let's pause for a moment and recap what we've covered so far. At the top level, there are two broad approaches to investing: active and passive. And within active, there are two distinct paths: discretionary and systematic. Now let's connect this back to our driving versus taking the train analogy. Remember, we said active investing is like driving. But when you're driving, you actually have two choices. One option is to follow Google Maps exactly, turn by turn, without deviation. That's like being a systematic trader or investor. The other option is to decide everything for yourself. Maybe you take the shortcut. Maybe you follow the crowd on a busier route. Maybe you just prefer a road that you've driven on before. That's more like being a discretionary trader or investor. And no, I'm not saying one is always better than the other. Anyone who's blindly followed Google Maps knows what I mean. But here's the point. These are two different ways of being active in the markets: discretionary versus systematic. Now, beyond just definitions, there are some fundamental differences in these two approaches. The first and the biggest one is what I call testability. That is, the ability to run tests or simulations on historical data, also known as backtesting. Here's what I mean. Suppose you create a simple rule. Buy the index every time the market drops 10% from its most recent high. In other words, whenever the market is in a 10% drawdown, you step in and buy. If the concept of drawdown isn't familiar, I have explained it in detail in the 6 key metrics video. The link is in the show notes. Now, because that's a rule, I can go back and run it on 10 years of historical data. I can test what would have happened if I had followed the rule every single time. Would it have worked in my favor? How much I would have made? How many such opportunities would I have got? All of that. If I'm a discretionary trader with a similar idea, I might sometimes buy at 7%, I might sometimes skip the 10% drop altogether, or maybe enter a bit later based on my reading of the market. And here's the catch. The discretionary approach cannot really be simulated or tested. Why? Because your judgment calls in the moment cannot be recreated on past data. You can't just look back at the chart and say, oh, at that point I would have done this or I would have skipped that. That's hindsight talk. That can never be an accurate representation of how you would have acted in real time in the past. And then there are some more second-order advantages of testability. Fair warning, this may be a tad bit complex, but it's equally important. If you are parallelly running multiple strategies, testability of rules naturally lends itself to portfolio-level simulations. Because a strategy operates on explicit, repeatable rules, you can run correlation analysis across strategies or assets, assess allocation-level drawdowns, and do scenario-based stress tests. You can also perform what-if simulations to test portfolios' response to varying volatilities, capital levels, market shocks, you name it. In contrast, discretionary approaches don't allow for any of this. The second key difference between discretionary and systematic approach is scalability. Generally, the more measurable a strategy is, the easier it is to scale. Think about it. If you are going to deploy large amounts of capital, wouldn't you want to know if the strategy still holds up at that scale or if it breaks down? Even discretionary traders ultimately rely on data over here. Metrics like volume, open interest, market depth, historical max drawdown, volatility become essential for scaling and managing large allocations. Without clarity on these metrics, you are essentially deploying capital blindly. The third difference is reaction time. Systematic strategies can sometimes be slow to respond to sudden market events. Discretionary traders, on the other hand, can react almost instantly to news or price action, and for some, it can feel psychologically far more reassuring because you have complete control, especially when market throws a surprise. But in my experience, reacting quickly isn't always an advantage either. Sometimes it leads to premature exits or poor decisions driven by emotion rather than reason. The third interesting difference is the narrative element. Systematic traders are frankly a bit boring. Ask them why they bought a stock and you'll get an answer in 3 words. It broke all-time high. But ask a discretionary value investor, for instance, for their rationale. They'll give you a full story, why they like the company, its philosophy, the management team, maybe even throw some anecdotes about the founder. As a friend of mine says, while one gives you data, the other can beat you at it with drama. Now, while I personally lean more towards systematic side of things, I have to admit that some discretion always creeps in. For example, how do you handle prolonged drawdowns? Or extreme once-in-a-lifetime events like the COVID crash. Imagine being a systematic oil trader in March 2020. What would you have done when the oil prices briefly went negative? I know by now you would ask which one of these approaches, discretionary versus systematic, is better. Honestly, it's hard to pick. If you're just starting out as a trader or an active investor, I'd say that a systematic approach is better to begin with. With rules already defined and a clear rationale behind them, your job is to simply understand the framework and follow it with discipline. Over time, as you observe the market and gain experience, you'll naturally develop intuition. And that's perhaps the right stage to thoughtfully bring in discretionary elements, layering judgment on top of a solid rules-based foundation. If you read the book Market Wizards, you'll see legendary money managers succeeding on both ends of the spectrum. Bruce Kavanagh and Paul Tudor Jones are famous for their discretionary global macro trading strategies, and on the other hand, folks like Ed Seykota and David Harding built empires as systematic trend followers. The contrast in their styles is profound, but the essence of all this is success in trading isn't about choosing the right style, as much as it is about being fully aware of the strengths and the weaknesses of your chosen approach, and being open enough to borrow from both. In summary, what we explored today was active versus passive investing and how active investing lends itself to discretionary versus systematic approaches. And if you're a newbie starting out, it's better to start with systematic approaches. So that brings us to the end of part 1 of this episode. With that, let's move to part 2, something more practical, and that's our weekly market metrics. Let's take a quick look at how the markets played out this week. On Monday, Nifty opened with a small gap and then followed through with a solid 200-point rally. By Tuesday, the momentum fizzled out and we saw a full sell-off. Wednesday brought a bounce back again, and then Thursday, right after the revised GST rates announcement, markets opened with a big gap of around 1%, only to give it all back later in the day. Almost a familiar pattern by now. This market just can't seem to hold on to gains, even when the news flow is extremely positive. Banks have been in a weak spot as well, and since they carry heavy weight in Nifty, it's hard to see sustained strength in the benchmark unless banking names show strength. Mid-caps on the other hand have been holding up a bit better. Across the 5 trading sessions this week, only Monday and Wednesday closed in green. The rest of the days ended in red. If we zoom out a bit going back to last Friday, Nifty and Bank Nifty had already started showing signs of weakness all through last week. This Friday, we did manage to close above last Friday's level of 24,400, but the overall sentiment still feels tentative at best as Nifty got sold off from 25,000 levels. Talking about rate of change, this week looks a little better than the last, with most indexes inching up. On a year-to-date basis too, we are just about hanging on in the green except for mid-select, which is in the red. Mid-cap select being in the red also correlates with the general lack of momentum in the mid and the small caps this year, impacting all the momentum factor players. Let me share something interesting I noticed. If you look up Nifty on a weekly chart over the last 12 weeks, it's been stuck in a really tight range of about 5.4%. Now, history tells us that such narrow bands don't last forever. They usually break out sooner or later. The tricky part, of course, is I can't tell you when exactly that will happen or which way it will go. What I've noticed in the data is pretty striking. If you try to predict the next 4 weeks, the direction is almost like flipping a coin, totally 50-50. But once you stretch the horizon beyond 8 weeks, that's when an upward bias starts to show up. Talking about sector-wise markets for the week, if you look at the table, the trend from the last week has carried forward. Auto and consumption are still holding their spots in the top 5 sectors. What's new this week is the entry of metals, commodities, and PSC into the mix. Speaking of commodities in general, gold and silver are consolidating around their all-time highs, while copper and natural gas continues to look bullish. Crude, on the other hand, seems to be flat to slightly negative at the moment. Moving on to overnight versus intraday structure on the indexes, this was one of those weeks where the gains came entirely from the gaps. Overnight, we were up about 1.68%, but intraday, the market actually slipped by 0.41%. Moving on to options, this week marked the first ever Tuesday Nifty weekly expiry since the derivatives were launched on Nifty. The index saw a 233-point range that day. Nifty did attempt to move higher, but around 1 p.m. from a high of 24,750, there was a sharp reversal. It was not an easy day for the short wall traders by any measure. Moving to Sensex expiry on Thursday, it opened with a strong 900-point gap, about 1.1%, on the back of GST rate cut news, but that momentum didn't last either. By the close, the Sensex had given back most of the gains, finishing at just 0.19% higher than the previous day's close. Option premiums hardly decayed that day except for the opening 5 to 10 minutes. On to the directional bias so far, Nifty and Midcap Select have inched up above their 21-day EMA but still below the 50-day EMA. Which means on a short-term basis they are positive but still negative on a medium-term basis. The other way to look at it is to compare the 21-day EMA value with the 50-day EMA value. As you can see, the 21-day EMA value is lesser than the 50-day EMA value. It again indicates weakness in these two indexes. Bank Nifty and Sensex continue to be weaker and below both the reference levels. Here's a bit of housekeeping stuff. There was supposed to be a settlement holiday on Friday, September 5th. Instead, a settlement holiday is now scheduled for Monday, September 8, 2025 on account of Eid-e-Milad. While trading on all exchanges will remain open, the back-end settlement of funds and securities will not happen. Here's the impact for you. If you are an F&O trader, any profits or credits from your F&O trades executed on Friday, that is September 5th, will not be processed on Monday. The credit will be delayed and will be available for withdrawal from Tuesday, September 9th onwards. For equity cash transactions, if you bought shares on Friday, the shares will not be credited to your Demat account on Monday as per the usual T+1 cycle. The transfer will be delayed and the shares will be credited to your account on Tuesday, September 9th. For any of your BTST trades, if you purchase shares on Friday, you will not be able to sell them on Monday as the shares have officially not been credited to your account. You can sell them only after the settlement is complete on Tuesday. Moving to our outlook for the coming week. Directionally again, looks like in the coming week, Nifty may hold on to the support at 24,300. The 24,300 to 25,000 zone looks very choppy to me. We need a conclusive close above 25,000 for any trend to emerge. The short time frame trend following strategies that I track on both Nifty and Bank Nifty are both short at the moment, but historically shorts don't last that long, so we are back to square one in terms of directional uncertainty. So that's pretty much for the long and the short this week. Hoping for better times. Till then, keep your capital safe and see you again next week.